Hey everybody, this is Kevin, a CPA that does financial planning. Going to go over the first quarter of 2018, the markets, what the markets had to offer. There's a story at the end of this slide deck that says sailing with the tides. Now, full confession, I'm not really a sailor, but they say that embarking on a financial plan is like a sailor, and you have to be willing to go through some turbulence. That sometimes, the waves can knock you off course. And, usually we don't go too deep into these metaphor, analogy, story type things, but I really think that it's a pretty doggone good one for the first quarter. So the first quarter of 2018, it seemed like we were going one place and we ended up coming another place. So the quarter was a bit strange. It was strange in the fact that both U.S. bonds were down as well as the U.S. stock market. Many people, and I'll get into it in a moment, think the reason why the stock market was down, it could have been because it was just an excuse to go down. It's gone up so much. But the other reason is because there's a fear of inflation. There's a fear that the Fed will raise interest rates. And then what happens when that fear is out there, even before the Fed raises interest rates go up, and that's kind of what happened, and bond prices go down, and bond prices move inversely. It's like a seesaw. They move inverse to the interest rates. So bonds did get hit, and the time when they first got hit was the time when we saw all the whitewater or the turbulence, if we're going to use that analogy again. But the stock market overall was down 0.64%. I'm teaching an investment class here at Maryville College, and we talk to these young people about the fact that it's really about the long term, and you shouldn't get so caught up on the short term. But I will tell you, it's very hard to not get caught up in it with the bombardment of information that we get every day. Sometimes I do wish that we didn't have all these devices and ability to track all our investments on a daily basis, because it can cause us to want to make bad long-term decisions in the short run. It can cause us to just want to make some decision to do something. But anyway, the U.S. market was off 0.64% for the quarter. International developed was off 2%. I am going to talk a little bit about currency today. Charlie and I look for messages to give you based on the markets, and so we'll talk just a little bit about currency, not to get into it so much that hopefully you'll fall asleep. Emerging markets. Once again, emerging markets have done very well in the last 2 years after being terrible for a number of years. So diversification works. Sometimes it works too well. But this quarter it worked in a really positive way to own some emerging markets, equities. Global real estate was down 5.79%. And again, I believe this is related to the fact that interest rates went up, and that people are afraid that that will cause REITs to lose money, or at least not be as much of a growthy vehicle as they've done in the past. And then foreign bonds, again, due to currency, were up about 1% for the quarter. So here was the quarter, if you look at it through the MSCI all countries. So this is the whole world, basically. And we get off to a fantastic start. Everybody says, wow, what a year. It was just incredible. And then all of a sudden, again, this says that Eurozone inflation continues to lag despite robust economics growth. And then global bonds swoon as investors bet on inflation. So that's really the reason that caused this nice little dip here. And it was more than a 10% correction. And so the rest of the quarter, you can see how it played out. The last year, up until this happened, this early February issue, the stock market was just going straight up. And you can look back to 2000. It's been really great to be an investor in equities. Here's the asset classes that did well, and most of them did not. But emerging markets value did well, emerging market regular, and the 1-month T-bills. So if you shorten up the ownership of bonds and you don't own 30-year bonds, even if interest rates rise, you can somewhat mitigate interest rate increases. And by the way, if bonds do go down in the short run, The thing to keep in mind is that the interest payments that you're going to be getting going forward are most likely going up. If interest rates are going up, you're going to get a higher interest payment. So, but in the short run, we understand that it can be a little bit discombobulating when these bonds that usually don't go down in value do go down. So here's U.S. stocks. U.S. stocks now make up 52% of the world capitalization. Fancy way of saying how much money people invest. 52% of all public investment is in U.S. investments, U.S. companies. Okay. I think the second message here is be careful of just making a story. Everybody said at the end of the year, well, with the tax cuts and businesses, they're just going to skyrocket. And so some people said go all into equities because of the tax cuts. Well, again, most of the equities in the U.S. Didn't have a great quarter. We still think investing all the time is a good thing, though. International developed first quarter. If we look at in their currencies, markets got hit pretty bad. 4.89% for value. But in U.S. currencies, because the dollar weakened against many other countries, we actually have a little bit better of a return, although it still is negative. And that is the reason, again, for emerging markets, why the returns were so good. In local currency, it was okay. In U.S. currency, again, we got higher returns in the emerging markets. One other thing about emerging markets is last couple of years, they've done very well. Last year, 24.93%, large cap. But when we look at the last 10 years, emerging markets have been a laggard. And, when we look at investment theory and we say the riskier something is, the higher the return should be, that doesn't always happen. And that has not happened in the last decade, with returns being around 3 to 4%. If you're interested in the countries, I'll let you take a quick look at this. You can pause the video. Who would have picked Finland to be the #1 stock market in the quarter? We wouldn't have, and that's the reason why we like to diversify. The #1 emerging market was Egypt, which had a tremendous growth of 12%, 11% for Brazil. These countries, sometimes we hear about the problems. It's amazing that markets don't always follow the narrative. And then this is the currency. And again, this is the reason why, being a U.S. investor, investing in dollars, we don't believe in hedging for equities. We do believe in hedging for bonds because bonds just don't have as big of a return as equities do. Real estate investment trusts, U.S. REITs did very, very poor for the quarter, down 7%. So let me just remind everybody that REITs went down because, again, interest rates go up. People think that real estate, they're going to be able to make less money because they're going to have higher interest payments. Well, the other side of the coin may be, and I use the terminology may be because we don't know what's going to happen in the future, but if inflation does come about, many times these real estate companies can raise the rent. I mean, literally, there's inflation, so they can raise the rent. So when interest rates have gone up slowly over periods of time in the past, it hasn't really crushed REITs. The REIT market is made up 56% U.S. and 44% is outside the U.S. And outside the U.S., once again, in dollar terms, only down 1.26%. Here's the commodities. You can take a peek at that. Commodities have not had good returns in the last decade. Fixed income. The bright spot of what happened in the first quarter is now the 10-year Treasury. This says 2.74, but it's actually up to almost 3%, where you can get 3% on a 10-year bond. Now, I'm not advocating to invest in a 10-year bond. I think a duration somewhere around 4, 5, or 6, or maybe even 7 will give you a decent return and not have as much interest rate risk, but it all depends on what you're looking to do with your investments. Municipals actually have a higher return now than treasuries, even though they're tax-free federally. So for high-income people, they might be something to add, and then AA, AAA, and then down to BBB corporates. You can see that they're paying 3.35, 3.88, and even a little bit higher now. The final thing about fixed income is the yield curve is flattened. That means you don't get as much return for going out longer, such as 20 years, 25 years, 30 years. So The impact of diversification. Diversification is key, especially if you get worried. And, you know, for a lot of people, nobody wants to admit that they get worried. But if your asset allocation is causing you to lose sleep, let's talk about it now before we have the next market correction. Let's talk about it. I mean, we're happy to do so. And then that leads us back to the fact that, you know, if we keep our course and we stay disciplined, the boat should arrive to your financial plan endpoint. So anyway, that's it for now. Hope everyone is doing well. Thanks again for watching. Kevin, a CPA that does financial planning. Thanks.